everyone, welcome to this week's edition of Midweek Market Update. I'm Ashley Rosser. Happy New Year's to you and your family. It's hard to believe here we are, first Midweek Market Update of January 2021. So excited to be here. We have some things to get in today. So the main thing that I want to talk about is what's the likelihood that the bull market's going to remain through 2021, right? That's what a lot of investors are wondering. We've seen a pretty significant run-up over these past few months. We did hit some correction territory in September and October, and since then, the markets have had a really strong performance. So the question is, what can we expect moving forward? And so nobody has a crystal ball. I really wish I knew exactly what's going to happen between now and the next 6 months, but we can look at some indicators and we can look at areas of the market that we should at least take notice of to help kind of guide what our forward-looking actions may be in the new year. So that's what we're going to get into. And so I'm going to switch sides here. So I know we've all heard this before, but eventually the stock market is going to be tied to corporate earnings. And that is just the way that it works, that stock market valuations, while able to run kind of untethered to corporate earnings for a period of time, at some point we'll need to reconcile. And there's one of two ways that we can reconcile this gap that we have here. So S&P 500 current valuations, corporate earnings. I mean, that is a significant gap. And so if for a second here, if we just want to look back in history, so back in 2002, oh, my screen does not want to stay. You see what happened here, where we were deviated here, and we know that what happened 2002. Look, we know exactly again what happened back in 2009. This screen is really sensitive today. Let's come back over here. So here we are again. Now we've been running extended though for a fair period of time. So the question is, what do we do with this? And so for now, we take it as a reminder that right now the markets are extended, they're overvalued. We're trading about 36 times earnings right now, which is, historically high when we look at valuations. So what do? Well, we can't just sit and hide forever because we know that these can run, they can run extended. So we have to make sure that we're looking at all of our other indicators before we make decisions, but kind of always keeping this in the back of our mind that the market's overvalued. And then we're going to have to see if the current environment that we're in for this year gives us the ability to start to make up some of this gap that we have between earnings and valuations. So something certainly to think about. Greed remains at all-time highs. On this scale here, particularly, anything over 90 is considered like astronomically sound the alarms high, and we're at like 95% right now. So what does that mean? It means that everybody's on the same side of the boat. Everybody is in the market. Everybody is likely close to being fully invested right now. Everybody thinks that the market can only go up higher. And when that happens, sometimes that is the trigger to set the market up, to trip up on itself. And so that's where we are. But again, greed has been running extended for a while now too. Now, we saw those greed readings come back down back in September and October when we had those other periods of time where markets came into corrective 10% situations, but then the market just kind of went right back up. So it didn't really, that correction didn't do a whole lot of its job, which was like to kind of burn off some of that excess. So we're back to being super greedy, still super extended. And when we look at our long-term moving averages, this is the S&P 500. So you can see here's our 200 moving day average, and we are trading significantly deviated from that as well. And so you can, in the past, we know that as we get as far as extended as we are here especially, you can see where that was obvious, bringing us back down to the 50-day, which acted as a line of support here. Happened again here. So again, we are really extended. So right now the market is just being dragged along by momentum. And so we just need, that is something that we need to be thinking about. So we need to make sure that as we're following our process, that we're following it very carefully, because while we can trade like this for a little while, now the good news, and I'm going to show you this on another slide, we have been trading sideways for a while. So I don't know if you can see here, we really haven't done a whole lot on the S&P 500 at least. That kind of allows us time when we trade sideways and kind of grind along like that. We're able to burn off a lot of that excess and kind of give the market like a little bit of time to catch up. One thing that is good is RSI has remained at a very consistent level at 58, so we're not super high on that RSI. Like we were here back in September, right before we had that significant 10% correction. So RSI, we're still kind of hanging here at a good level. So again, these are things we look at. So any one of these things are not reasons that would necessarily tell us now we need to make a change. If we're in the market and we're invested, what it does tell us though is that we have to be very kind of like in tune to other things that are happening, so that if something does potentially come as an exogenous event to disrupt the market, that we kind of need to make sure that we kind of have a plan for where would we go if what has been working for a while now looks like it might not work for the foreseeable future. So that is what I wanted to show there, and then I can get our screen here. So it's not all bad news. I don't want to make it sound like it's bad news, because markets really have been performing very, very strong since November. We've seen a really nice run up. Matter of fact, if I show you here real quick, just kind of what's happened since November, it's all been, very positive. You can see that markets have had just a really nice run since November up until now. And then I wanted to kind of just show you though what happens in December until now. And so you can see the S&P 500 here has been fairly muted in terms of its returns over the past month if we look back. So again, showing how we've been kind of trading sideways for a period of time here. Now we talk about the Santa Claus rally. Santa Claus rally is the last 5 trading days of December and then the first 2 trading days of January, and has been not completely exciting, I guess you could say. It's been somewhat of a muted rally. So although some people say, well, that's because the rally came earlier in December when we had some of those other larger run-ups, and that's very possible. So again, we've been trading sideways for a little while here with the S&P 500. I think that's probably a good thing because it gave us the time to kind of burn off. In the meantime, as we talk often about how we invest in those areas of positive momentum and relative strength, they have been doing very well. You can see here we've been outperforming the S&P 500, which is our long-term goal, been doing that. And when we talk about where we should be invested in, so coming back to DALI, so remember DALI, dynamic asset level investing, telling us dynamically, tactically, where should we have exposure to, where should we be avoiding. That's the whole idea with this. So you can see DALI remains very centered on domestic equities, mid, small, large cap growth, technology, consumer cyclicals. And I mentioned last week how we had added some international exposure a few weeks ago, and that was because international literally came from last place and has been kind of like on a tirade up since the summer, and we've been watching that as it's been happening. And so we did add a very small minority position to international to kind of take advantage of that strength as it came. And then so we haven't seen a whole lot of change here. Now today markets had an interesting movement. There was a lot of areas that really popped after the morning opened. They were really running kind of hot. And then with some of the events today that obviously have happened within government and with the Capitol building, we've seen some of those gains repaired at the end of trading off of their highs. Still overall a pretty decent day, so we'll see what happens now the rest of the week. We've talked before about how markets like consistency. They kind of like to know what's happening. So they originally were kind of expecting that we would have, that the Senate would probably not get overturned, which would have had a gridlock government, which the market likes because it just prevents significantly right or left things from happening. They like to kind of keep it in the middle. That's just the way that the market works. So I wasn't sure actually today what the market's response would be, but it seems like it was fairly down. Futures were significantly down this morning, and then it kind of shrugged it off and kind of moved on. So we'll see throughout the rest of the week what plays out there. So really the story is that I do think that the bull is here for a while, but just as always, it is really important to make sure that you have your process in place. Make sure you have you know why you're investing in the areas that you have. That's really important. If somebody asks me, why are you guys allocated in ABC fund? Why do you have holdings there? And I can tell you, because their relative strength is here, because their momentum is shifting here, because they're on a buy signal and they're on a positive, their momentum is positive. And these are the things that we look at, and so we know very quickly this is why we hold this fund. So you should have some sort of a process, and just saying because I just like it, that sometimes doesn't always work out in the long run. So make sure you know why you're holding what you're holding, and remember that if something begins to not work, it's likely to not, when other things are working, it's likely then that will continue to not work. So we have a rule where we let our winners run and we sell our losers quick. That's just one of the rules that we abide by. So you should have your own rules, knowing why you're invested in what you have, when will you sell, when will you consider purchasing something else, and make sure this is the time now. So we've had a nice little rally. Make sure that if you're not sure about the risk in your portfolio, if some of those corrections that we saw back in the fall, if they made you really uncomfortable, you might have too much risk in your portfolio. So now would be a great time to consider maybe making some changes there. Otherwise, we're here. We would love, if you have questions, for you to reach out to us. AshleyR@victoryfiduciary.com. You can always email me questions, or if you have a topic that you'd like us to get into for next week, we would love to be able to try to start including them. I mentioned last week we're going to be starting some new things within this year, but we'll be able to do some podcasts. I'll be doing some other education and videos, not necessarily just regarding the market, but other topics that I think investors should at least have an understanding of. So we'll be bringing them to you. Otherwise, I hope you have a great rest of the week, and we will see you next week. Take care.